Hello and welcome to SharesCart. So India's largest digital health platform is still bleeding but changing. India's digital health market is worth $17.81 billion today and is projected to reach around $107 billion by 2033. That kind of tailwind tends to create interesting companies. API Holdings is one of them, and most retail investors haven't looked at it closely enough. The company started in 2012 as a last-mile pharmacy delivery experiment. Over the next decade, it evolved into something much larger. A vertically integrated platform operating across 5 segments: PharmEasy for online pharmacy, Ascent for B2B, pharma distribution, Thyrocare for diagnostics, Aknamed for hospital procurement, and Docon for clinic management. In FY26, consolidated revenue stood at 6,869 crores. Ascent is the largest contributor at 59%, followed by PharmEasy at 19%, Thyrocare at 12%, and Aknamed at 10%. What makes the model structurally different from a pure e-pharmacy is vertical integration. API Holdings participates at every node: manufacturer, distributor, pharmacy, diagnostic lab, hospital supply chain. That breadth creates cross-sell opportunities and data advantages that a point solution simply cannot replicate. The financial history, however, is difficult. PAT was negative 3,992 crores in FY22 and still negative at 1,572 crores in FY25. 3-year revenue CAGR is 0.83% against an industry growing at 13 to 15%, and all 4 co-founders have exited. These are not minor footnotes, but the operating trajectory has shifted. EBITDA turned positive in FY26 at 62.5 crore. Operating cash burn reduced 97.6% from negative 2,589 crore in FY22 from negative 61 crore in FY24. The debt equity ratio fell from 1.69 in FY23 to 0.62 in FY25, driven by a rights issue and partial debt repayment. The profitable core here is Thyrocare, which contributed rupees 279 crore in EBITDA in FY26. PharmEasy and Aknamed remained in EBITDA negative and are primary drag. On valuation, listed peers trade at a median market cap to revenue multiple of 6.87. Adjusting for unlisted status, negative earnings, and holding company structure gives an adjusted multiple of 3.72. Applied to FY26 revenue, the implied intrinsic value is Rs 15 per share against a current unlisted price of 5.60, a 168% implied upside. That said, the 15 rupee figure is anchored to unaudited provisional revenue, and any downward restatement or delay in the profitability timeline compresses the multiple. The investment case is straightforward to state and hard to execute. API Holding needs to convert its 9.1% EBITDA margin into positive PAT by FY27 while simultaneously reaccelerating revenue towards the industry CAGR. If it does both, rupee 5.60 looks deeply undervalued. If either condition slips, the current discount is justified. But for more such information, you keep watching SharesCart.